back to the series of Business Studies Chapter 8 Controlling. In this video, we are going to learn about modern techniques and responsibility accounting. Okay, first of all, modern techniques. Modern techniques are the techniques which are used in modern days. That means these techniques are used from recent days. There are two types of modern techniques. First one is return on investment and the second one is ratio analysis. We'll be going to learn one by one, starting with return on investment. Return on investment is also called as ROI. It's a useful technique which helps to measure whether invested capital has been used efficiently for generating sufficient amount of return or not. ROI is used to measure overall performance of organization, or it can also help to analyze individual departments or divisions. It can be calculated by using this formula: ROI is equal to net income divided by sale into sales divided by total investment. Moving on to the next modern technique, that is ratio analysis. Ratio analysis means analysis of financial strength through calculation of ratios. Basically, it calculates the relationship between two values. It's the most common used techniques. This ratio analysis mainly further classified into small groups. We'll be discussing one by one. First one, liquidity ratios. These ratios measure the strength of an ability of the business to pay the short-term debts or to pay the amount due to the investors. The second ratio is solvency ratio. This solvency ratio calculates the long-term solvency or strength of a business that have ability to serve its indebtedness. Next ratio, profitability ratio. These ratios are calculated to analyze the profitability position of the business. How much profit that particular business earning, like that. So moving on to the next one, that is turnover ratio. These ratios are calculated to determine the efficiency of operation based on the effective utilization of resource, whether they're using resource efficiently or not. Moving on to the next topic, that is responsibility accounting. Responsibility accounting is a system of accounting in which different sections, divisions and departments of an organization are set as responsibility centers. They are responsible for that particular department. This responsibility center broadly classified into four groups. Actually, these classification explanations are not important. We've only required points, even though I'll try to make sense. First one, cost center. A cost or expense center. It's a segment or a section in which managers are responsible for the cost incurred for the particular center. For example, in a manufacturing organization, that particular manager called manufacturing manager is responsible for the cost center or expenses which is happening there. Moving on to the next center, that is revenue center. It's a primarily responsible for generating income. For example, marketing department, they are responsible for the revenue generated in that particular organization through leads or whatever by market. Moving on to the next center, that is profit center. A profit center is a section of an organization. Their managers is responsible for both revenues and the cost. For example, repair and maintenance department of an organization, that includes to minimize the maintenance cost of that department, will help you to increase the profit. Moving on to the next center, that is investment center. Investment center is responsible not only for the profit but also for the investment made in the center in the form of assets. So that's it for this video. If you like this video, hit like and share with your friends. Thank you for tuning in. See you in the next series. Bye. Welcome back to